Matt Orton of Raymond James Investment Management, who's joining us on the show right now. Matt, thanks for taking the time out and speaking to us here on NDTV Profit. Perhaps my questions are more or less similar in this case, Matt. Firstly, want to understand what you made of the Federal Reserve's chairman's commentary coming in over the weekend, and what sort of an implication could it potentially have when it comes to their rate decision on the September 18th? What's the way forward? How are you assessing this at the moment?
Good morning. And I think it was very constructive what we heard from Powell. I agree with what was said, that the stage has definitely been set. I think this was the clearest signal yet that we've received from Powell that rate cuts are going to start in September. And really the question that remains is how fast and how deep are those cuts really going to be? Powell's the master at leaving optionality open. And I think he did just that, using Jackson Hole to not commit to 25 basis points at every meeting or the need for a 50 basis point cut. He left it data dependent. And when I look at the totality of data that we have, I've been very constructive on the U.S. economy, and I remain constructive. I think there is some cooling that we're seeing with respect to the economy. There are some cracks that we're starting to see with respect to the labor market, but none of those say immediate recession. None of them say that we're going to see the labor market fall out from under us. When you have corporate profit margins standing where they do today, which is the highest they've been since 2021, none of that signals that we're going to have mass layoffs. So I think the market is a little bit offsides in pricing in 100 basis points of cuts before the end of 2024. So there might be some indigestion. We're going to get the jobs and payrolls report next week. So I think that's going to be the next big catalyst and data point that might inject some volatility into this market. But I remain constructive, and I've been telling clients that if we do have volatility related to any rate pricing or concerns around the economy, I would be using that opportunistically in portfolios to continue adding to positioning.
Right, man, over the last 2 to 3 months, what we've seen is a lot of changes when it comes to jobs data. So 1 week you'd have some positive cues coming in, the next week you'd have negative cues coming in, then the markets would react accordingly. We have about a month and a half left for the September policy between now and then. What are the key variables that will be out over the next course of 1.5 months that could potentially either change the course or let the Fed be on the course as far as their own interpretation of many of these macro indicators are concerned?
Right. So that's a great question to follow. And I think what you need to watch is the continuing claims that we get on a weekly basis. So are we starting to see continuing claims, meaning that there's more people sitting around still looking for jobs that aren't able to be hired? I don't expect we're going to see those tick up too substantially. And in fact, we're starting to work through some of the volatility we've had in the jobs market from hurricane, issues in the U.S. So I think we're going to see a little bit more stability through the continuing claims data on a weekly basis. And it's the payrolls report that we're going to get the first Friday in September. That, I think, is going to be the first really critical data point for the market and assessing whether 25 or 50 basis points, either in September or November, is going to be likely. The inflation prints that we're going to get in between, we get PCE this Friday. There's going to be another CPI print in between as well. I don't know how relevant that is unless there's a mass spike up in inflation, which I don't expect to be the case. So I think really investors are going to be focused on the jobs market, but I do think we're going to get a little bit more consistency in the data just because there were some aberrations due to weather-related events over the past couple of weeks.
Matt, in terms of your own assessment, your own analysis, how much can this rate cut cycle come through? Now, of course, the street is expecting about 150 basis points over the span of the next 6 months. But we know how things have panned out over the last couple of years. And this has been since, the Federal Reserve has been indicating rate cuts. What is your own, projection when it comes to rate cut cycle here?
So my base case is that we're definitely going to see 25 basis points in September. We're going to see 25 basis points in December. November, I think, is a question mark simply because it's the day after the presidential election. So not that the Fed is supposed to be following politics or vice versa, but I do think that injects a whole nother element into the calculus. And I think having strong consensus on the panel of voting members is going to be critical. So if you see some robustness or strength in the jobs market, I do think November could be a question mark. So when you kind of take that, either we're going to get 50 or 75 basis points is my expectation. How do you translate that into the market and where there could be opportunities? I think number one is there are a number of rate sensitive pockets of the market that really haven't moved too much. We've finally seen life in US small caps. And I think that trade can continue because there's just such a mass historic valuation difference between small and large caps. We're getting to an inflection point with respect to earnings. So I think that can be supportive. When I look overseas as well, I think there's a lot of opportunities in emerging markets as well. Emerging markets have been really challenged outside of some pockets of strength like India, which I've been very overweight. But I do think there's an opportunity for EMs more broadly, except, I'll exclude China from that equation, where a weaker dollar, I think, can translate to more enthusiasm around the growth prospect. It's been a perennial underperformer relative to the rest of the world. So that's another area of value once we start to get rate cuts. And I think that's regardless of the depth of cuts that we have moving forward.
Speaking of markets like India, many consider Indian markets to be expensive, but do you still think that there is opportunity here?
I do think there's an opportunity. A lot of clients have pushed back against India or continuing to add, saying that valuations are expensive, but valuations can be expensive. You can grow into that. And India, to me, is a long-term secular growth story where there's just a tremendous amount of opportunity across infrastructure, financials, and really it's been a broad market story that's been working. So for me, what I like in India right now is really playing an increase in quality. You've seen an emphasis on earnings delivering, on companies returning free cash flow to investors. So I think leaning into the best assets across sectors. So in autos like a Mahindra, where I think there's clear visibility. One of my favorites is ICICI Bank in the financial space. That's just, an upper teen return on equity compounder. I think there's still a lot of value there, and those names haven't fully recovered relative to the rest of the Indian market and the global market. So I do think it is a time to add, and it especially be adding on weakness.
All right, Matt, we'll leave it at that. Thank you so much for joining us and giving us your views on, the various aspects with respect to current markets. Of course, Matt Orton for now.